All right, well, let's start. So thank you very much for joining another Into the Block webinar. Every few weeks, we try to discuss some of the hottest trends in the crypto space. My name is Jesus Rodriguez. I'm the CEO and and co-founder of Into the Blocks. And today we're gonna be talking about a very hot topic about yield generating strategies from the quantitative perspective. A few weeks ago, I did a webinar about high frequency trading strategies in DeFi. So this is sort of a complement. So a few weeks ago, we talked about active and high risk strategies, and now we're going to talk about passive and yield generating strategies, but both with an angle in terms of intelligent trading and signaling and things like that. So the agenda is going to be super simple. So we're going to talk about a DeFi perspective in terms of yield generating strategies. What does it take to adapt this type of strategies to institutional grade level? So we spend a lot of time building quant DeFi strategies, partnering with large crypto institutions in this. So we're going to share some ideas, some things we have learned, but and try to help you think about this space. And then I have a few slides at the end to talk about risk. I mean, risk is a very important element of quant DeFi strategies, and at least I would like to show you how we're thinking about risk and outline a few ideas in that area. And then we're gonna try to give it practical. So we have a few examples, and we're gonna do all that in only 30 minutes. So I'm gonna go super quick. So as we do every time, a quick update about Into the Block. The last webinar was 3 weeks ago. Since then, we have done a lot of new announcements with customers. If you follow our blog, you can see that every other week we have been announcing new customers, such as the Luna Exchange that recently got acquired by the Currency Group. This is a new an extension of our partnership. They launched a new set of analytics in their pricing page. Indodax, that is the biggest exchange in Indonesia, and they enable analytics in their trading interface powered by into the block. So the GoPax, the Korean exchange, that you can see the analytics in Korean. Their Plasma Finance as well is live with analytics about into the block. So is FX Street as well, and also xt.com. So and we have announced a few more. I have a few more coming. So at the moment. At the moment, we are our customer base has grown tremendously on the institutional front, and more, what is more important is that more and more of these customers are going live with their integrations with Into the Block analytics. In terms of the product, obviously we're in the tail end of Q1, but we have a few things that we cannot quite disclose. But I'm gonna give you a few headlines of what's coming in early Q2. So we're gonna be launching some work related to provide a real-time view of the entire crypto market, or at least what is important. So our research team has done a lot of work on trying to determine what are the key things that people pay attention to, try to get a macro view of the market and do that in real time. So we have some interesting work there. And of course, we're going to launch NFT analytics, because what else do you do in this market if it's not to pay attention to NFT? In the same way that we launch a large portfolio of DeFi analytics, we want to make Into the Block the best place for NFT analytics, and that's coming. So that's it in terms of the update. Let's talk about the session today, which is related to quant yield generating strategies, but from the DeFi perspective. Just a quick clarification. Into the Block is very well known as a crypto analytics platform. And I've been explaining this multiple times because it's not something we publicize. There is a second division of Into the Block that what it does is build quantitative strategies for both CeFi and DeFi, and we have partnered with some of the best brands in crypto and asset managers in crypto, deploying large volumes of capital into these strategies. And a lot of what you're going to see today here, as well as what I explained in my previous in the previous webinar, is what we have learned in this short journey trying to build this type of a strategy. So it's very practical from that perspective, and we also will be the first one to tell you that there is a lot that we don't know. So when we think about yield generating strategies from a quant perspective, typically people associate yield generating with debt, right, and fixed income market, and obviously the history of financial markets is a history of debt, right? From the very beginning, debt was used to finance wars across many kingdoms, and then obviously that vision has evolved. If you to modern yield generating today in DeFi, if you pick any asset class through the history of financial market, there is a debt component to it, and throughout the recent history of capital market, fixed income and yield generation has created empires, right? Like Pincos, like Pinco, like Janus, like at a few years ago, what Drexler was able to do with York bonds, right? So it's there is an entire subset of capital markets that is devoted to yield generating strategies. From the quantitative perspective, when people think about yield generation strategies, they tend to think mostly, okay, so we're investing in bonds and you get a yield, right? Or we're investing in equities and you get a yield produced by those equities. But that's changing a lot. So in recent years, quant models and intelligent models have made inroads into yield generating strategies. There are three main trends that have been pushing this. One is the school of smart beta techniques. So if you follow factor investing, smart beta is this school sort of derived from the factor school of thought of the Eugene Fama and French sort of methods in which you can create a portfolio of factors such as value, momentum, carry, and others, and try to earn a little bit higher beta in a portfolio, and a lot of those factors sort of apply to fixed income and other sort of debt instruments. So there is an entire school of smart beta for yield generating strategies. There is also this vehicle called yield-based options that are based on yields for a specific fixed income or equities or different type of securities. And obviously, because everything in the world has an ETF, there is an entire school of thoughts of creating ETFs just based on yields. And you have seen more of these ETF products based on yields make it into modern portfolios. Now, when it comes to decentralized finance, the entire world of DeFi and what's happening with liquidity mining and yield farming and this sort of thing sort of introduces new dimensions when it comes to creating yield generating strategies with a quantitative lens. There are many factors that we can outline here, and I'll try to walk through how we're thinking about this. But obviously, the fact that there's near complete transparency, the fact that you can look into the blockchain and actually see what everybody's earning, what the protocols are producing, how the protocols are behavior, it adds an entire dimension to yield generation when you're looking at it from the trading strategy standpoint. Also, the diversity of protocols. So you have many protocols for lending, you have liquidity provision protocols, you have staking protocols and things like that. And the fact that they're programmable, that you can compose them into other strategies, but they're also subject to governance protocols and governance dynamics, right? So you can create an entire set of yield generating models just based on the governance dynamics of a specific protocols, and the frequency is also higher than in traditional yield generation strategies. So you're not looking at something that is look at a 24, 36 months yield, but you can look at things that return almost a daily liquidity just based on the dynamics of these protocols. A very powerful idea that I think is probably worth highlighting when you start thinking about yield generation in DeFi is that the line between beta and alpha, it becomes very, very blurry. So typically most investors associate yield generation with beta results, so very low returns but very low risk, and then alpha results with high returns and high risk, and that's just a traditional view in the market. So yield generation lives in this area between beta and a smart beta, in which you're taking some manageable risk and the returns are okay. Compared to those risks, and certainly smart beta producers tend to produce better risk-adjusted returns than most strategies. What has happened in traditional markets is that because there has been a boom in terms of passive investment lately, that space has been completely oversaturated. Now, when you think about DeFi, I think the line between what is alpha and everything else is blurring, because if you can earn 30% on a yield generation strategy today, well, is that alpha or beta? I mean, certainly not beta, because you're outperforming any index that you can throw our way. So these constructs of what's alpha and what is beta relative to an index, I'm not entirely convinced that applies when it comes to DeFi yield generation strategies. And this is something that we spend a lot of time thinking about. So what I'm trying to say, probably not very eloquent terms, is that there is a way, right? DeFi yield generation models enable a way to earn alpha with relatively low risk today. That might change, right? Or is likely to change as the market evolves. But these days, you can earn very alpha-like returns with beta-type risk, right? And that's something that is uncommon in capital markets. So there are many building blocks that you need to consider when developing quant DeFi generating strategy. So anybody can create one or two strategies. Building at a scale a portfolio of dozens of these things requires quite a bit of infrastructure. So when we think about the building blocks, right, that the market today provides to enable the creation of yield generation strategies, there are three fundamental primitives that are driving this. So you have protocols for lending, right? Compound, Maker, and others, Aave. You have AMMs, Uniswap, SushiSwap, Balancer, PancakeSwap, and others. And you have staking protocols as well. There are others, but I think these three primitives are driving the bulk of yield generation today. And then on top of that, you have all sorts of vehicles that sort of accelerate what you can do in yield generation models. So you have things like decentralized derivative products like Hedgehog or Opium that are very interesting. You have flash loans, so the fact that I can get a loan in a single transaction and repay it back with protocols like DYDX or Aave. What is happening with synthetic assets is fascinating, right? The fact that you can have synthetic assets that represent other vehicles such as commodities or stocks or other things as part of DeFi protocols is very interesting. Or the fact that you can earn token rewards by supplying liquidity or staking assets into a specific protocol. So we think all this, there are others, but we think these things are accelerating. And then on top of that, when you combine these mechanisms, is when you start creating strategies that become super interesting. There are many ways in which you can earn yield in DeFi protocols today, but so you can play in all sorts of protocols, even in some very early stage one, but doing it at a scale requires, and by scale I mean large pools of capital that care about risk on large amounts of strategies or across many protocols. That does require a lot of infrastructure. So in the next few minutes, I would like to walk you through what it typically takes to build institutional grade DeFi strategies for yield generation in the current market. So think about a large asset manager, even in crypto, big custodians, big lenders. that are looking to earn yield in their assets. And these entities are looking to deploy large amounts of capital, but obviously want strategies that kind of scale across different protocols and things like that. Those are problems that we're dealing with, and it's really not very trivial to solve. To think about these problems, right? There are three main vectors. So if you're a large institution in the crypto space and you're looking to earn yield, the way that you think about yield generating strategies is three main dimensions to it. So you're typically thinking about high capacity. So can you deploy large pools of capital? Also, the risk has been very low or manageable, and also that they trade on a passive way. It's not things that are taking trades that are placing trades every block, but just every few hours, every few days, every few weeks, things like that behave similarly to passive, to investments in indices or ETF in traditional market. Now, if we take these three vectors and try to extrapolate that into a more sort of layer base of more pragmatic base, form of how these capabilities map into DeFi generating strategies, we can have something like this. So let's take, there are all sorts of building blocks that need to be put in place in order to enable large scale DeFi generating strategies. And this is something that in our experience, most people ignore, because it's so easy to create one or two strategies that produce a high yield. But can you do it with 100 million? Can you do it across many protocols? Can you minimize the risk? Those are the things that make that equation particularly difficult. So at the very bottom of this, you need to integrate with a ton of protocols. So you need to know which protocols are you playing with, and there are new protocols being produced literally on a weekly basis. So this space is moving very, very fast. So keeping a layer that allows you to integrate all those protocols is very important. Then there is what we call a strategy infrastructure blocks that are sort of very, very specific to enabling complete automation in yield generating strategies. And these are just a few examples. So imagine a smart contracts that assemble positions programmatically. So you're trying to earn a yield, let's say in a protocol like Maker. So entering that position, leveraging that position, if you're gonna do so, and doing it programmatically is important. Then exiting the position is also important if there are risk conditions detecting. So being able to monitor risk intrinsic to every protocol is very important. And if there is a risk condition, you need to have triggers to be able to exit very quickly, because if you're playing with large amounts of capital and there is and you're at a risk of liquidation and Maker, it can really hurt, right? If you lose a large portion of the principal because you're not monitoring risk, or because you are monitoring risk but you were not able to exit very quickly, then the yield that you earn, being able to collect it regularly, daily, every few hours, every few days, and distribute it accordingly, monitoring the entire thing. So being able to monitor all the trades, all those positions, those are things that typically need to be built. And of course, security. Every other week, we hear about new hacks on DeFi protocols, or people that lost a lot of money in this space. So designing with security as a first-class citizen is important, and those are the building blocks, right, that you use to enable all these type of DeFi quant yield generating strategies. But those are not the only problems that you have. You need to deal with custody, right? If you're playing with large amounts of capital, how do you take custody of those, or which platforms do you integrate? And I will show you a little bit. We are disclosing a whole lot about what we're doing. And obviously clients so need to deal with custody, need to on-ramp funds, need to monitor the positions on their own, and being able to visualize where how much yield are they earning and what is the performance of a specific strategy. This all looks good as a conceptual thing, but let me put it in practice for you in a few practical examples. And I'm gonna drive the example from the three main building blocks that I discussed before. So liquidity provision, lending, and staking. And to make it sort of more clear is we'll try to contrast how a basic strategy in the space looks like with a more enterprise institutional grade strategy. So a basic strategy for liquidity provision these days, you can earn quite a bit, right? If you supply liquidity to protocols like Uniswap, 1inch, Balancer, and others. So very simple, you supply liquidity, you earn fees. Except that if you're playing with large amounts of capital, you're subject to things like impermanent loss and all that. And how do you even select which liquidity pool to play with if you're trying to deploy $10 million, right? Like, how do you do that? So a more interesting strategy in this same domain is something that will use certain level of intelligence to balance allocations across different liquidity pools. So suppose that I enter a position with Ethereum, and then there is many liquidity pools across different protocols that are producing different yield, different returns, different fees, but they change, right, based on different market conditions. So imagine if I have something that is continuously monitoring all those pools, and I'm distributing it, right? 2 million go here, 1 million go there, and then I'm doing that recurrently, right? So every day I sort of readjust to the conditions of the market, and because of risk, you try to hedge the impermanent loss risk. Like, what would happen if Ethereum goes up or down drastically? You take positions on derivatives or options and futures to try to hedge that exposure. So to play at an institutional level, right, this is something that could work. This is something that won't, right? Because you're exposed to all sorts of risk, and it certainly doesn't scale to large amounts of capital. A similar example we can see with lending. You can supply collateral to many platforms like Maker or Compound today and earn some rewards. But again, if you're playing at with large pools of capital, that might not be the safest thing to do, because you're exposed to risk like liquidation. So at some point, your position might be under collateralized given the conditions of the market, even something that is outside your control, for that matter, and you might be liquidated a large portion of your position. So how do you, as a large asset manager, how do you play in that space? So here's a variation of that type of a strategy that is more appealing at an institutional scale. So imagine the same. You start with certain pool of assets. Let's say stable coins in this case, but depending on the protocol you're playing with, whether it's Aave, Compound, Maker, or other, you can actually use some intelligence to lever up that position, right? And if you start with $1 million, go lever up 3x and have $4 million, 3 plus 1 at some point, and trying to understand the level of risk that you're incurring, supply that collateral. So you can use a mechanism like flash loan to lever up the position and then supply that entire amount to the DeFi, specific DeFi protocol that you're using, and then earn rewards based on the total amount. But because you lever up the position, you're also exposed to an even higher risk of being liquidated than if you would have supplied the original amount that you were trying to play with. So you need to develop a smart contracts that monitor that risk, whether it's liquidation, whether it's the price of comp or DAI or things that you're exposed to, and try to extrapolate potential risk conditions based on that, and exit the position accordingly. I see some people have raised their hands with questions. Please use the chat or the Q&A panel. The Q&A panel better, and I'll stop multiple times to take questions, to try to answer those questions during the presentation. As a matter of fact, we don't have too much left. So similar example could be used in a staking protocols. Again, you're sitting on a ton of Ethereum assets today, and a normal thing to do will be to stake in an ETH2 and earn some rewards. Now you can think of a smarter version, a larger scale version, institutional grade version of this strategy in which you have some intelligence that allows you to know how to lever up that position against using a flash loan, and then you can supply those the lever up position to staking protocol, but also supply part of the position to an AMM pool, collect the fees, and keep staking more and more recurrently. So you're earning more rewards, and same hedging the risk with options all throughout. Again, extremely difficult to build, but strategies that produce a higher yield and with very low risk conditions. So some things that we have learned when building this type of a strategy. So rapid experimentation is key. So testing a million ideas to see what works and what doesn't work. There are a lot of things that look good on paper, and when you look at the data, it doesn't make any sense. Be aware that yield generation is happening outside Ethereum. It's not an Ethereum game anymore. There is a lot happening in Binance Smart Chain with PancakeSwap and other protocols. There are things happening in Polkadot. There are things happening in Solana with Serum. Then exposure to multiple protocols is key. Like doing this with a single protocol, it's not, you cannot scale this to an institutional grade level. And infrastructure is essential. So better infrastructure beats better strategies any day of the week when it comes to yield generation strategies. And you need to think about risk. And we're going to talk about risk in the last part of the presentation. There is a lot of risk, intrinsic risk to this type of a strategy. So bottom line, anyone can build one or two yield generation strategies by themselves, but with a small capacity. By doing this at large scale with institutional grade capabilities requires a ton of infrastructure. So I want to take a couple of slides to this is an area that we spend a lot of time thinking about, like how do you do risk management? And we don't have a magic answer here, but I'll point out a couple of ideas. So first of all, forget about traditional portfolio theory. Everything you learn with Markovit's portfolio theory and all that does not apply in DeFi. So you cannot construct a portfolio of strategies just using those traditional portfolio metrics. We need to think a little bit differently. And I don't know exactly what the formula is. I don't know if there is a formula. I don't know if this is quantifiable in any form, because there are many different types of protocols that are just hard to come up with a uniform metric. But what I do know is that there are certain categories of risk that you incur, and we try to place those in a common framework that helps us think about it. So at some level, there is an intrinsic portfolio risk that you take. So if you're playing in compound, well, there are liquidations. So this is a capability of the protocol. It's not a bug. It's not a hack. It's something that happens in the protocol, but it's risk that you're taking. If you're in AMMs, there are imbalances and things like that. There is a lot of front running happening that you need to deal with. There is also exogenous factors, risk factors such as hacks, right? What happened the other day with PancakeSwap and what has happened with Pickle and Cream and many other protocols. So this is something that is sort of hard to quantify, but happens. There are forks, and all there is liquidity attacks. Like initially the vampire attacks of SushiSwap to Uniswap that you inherit when you're trying to build these strategies. And then there is other things, right? Miscellaneous risk conditions that happen because of the nature of DeFi, like for instance, the DAI manipulation attack that happened in December, where somebody manipulated the price of DAI in Coinbase and went to Compound and liquidated like 300 million dollars or some ridiculous number like that. There is also things like in Binance Smart Chain, it's highly centralized. So you're dealing with all other levels of risk that are just very difficult to quantify, and you should just design for this thing. So what we try to do is to, as much as we can, build for risk conditions. So if it's liquidation, we monitor for those. If it's imbalances, we monitor for those. And we try to imagine, okay, how would a hack in this protocol would look like? What would be the manifestations of it, and see if we can actually plan for any of it. Then I keep talking about I love what we're building, and we cannot disclose too many things here. I've been clear about that because it's work that we're doing with crypto asset managers and hedge funds and things like that. But I would like to give you a sneak peek of the type of infrastructure that you need to build, or some of the things that we're building. In that at least will point an idea of the things that you need. It's gonna be a little bit hard to follow or to read for that matter, but we'll share the slides after the presentation. So think about two fundamental layers, right? A layer that obviously we interact with different blockchains, fundamentally Ethereum and some Binance Smart Chain. And on top of that, there are two main layers. One layer that has all sorts of signals that we use as part to trigger different conditions on the strategy. So for instance, things like integrate with different protocols like Maker, Uniswap, Curve, and others. Signals are based on mempool, the state of mempools that can predict specific transactions, what will happen to our positions, things that allow us to replay transactions offline and try to estimate. In the previous webinar, I alluded to some of these things. Then, as I mentioned during the presentation, there are components that assemble and disassemble positions on the fly. You're gonna start earning yield in this thing and gets assembled on the fly. There is components that integrate with things like Credo or Fireblocks or Copper or other custodians for onboarding large pools of capital. Heuristics for accumulating gas ahead of time, right? Like when gas is cheap, assembling, disassembling position, collecting fees costs a lot of gas. So we accumulate gas ahead of time based on certain heuristics. Transactions that we place through private pools, right? So they're not front run and things like that. And all sorts of risk, a lot of risk monitors, right? Things for liquidation, imbalances, prices of assets that we care about, a lot of things that could trigger a risk condition. And then we do a lot of work on visualizing this and providing customers with a lot of visibility into that. And this is ongoing, right? Like this is a living infrastructure architecture that keeps evolving. And every other week we realize how much we still have to build. Right, so because this space is so new and it's changing so fast, so this gives you an idea of how a quant infrastructure for both HFT and yield, but we're looking at it from the yield generation perspective, could look like. And obviously across the board, you have to have things like security across all the smart contracts and things like that. That's all I have. So a quick summary here. DeFi offers a new playground for quantitative strategies in the area of yield generation. Building enterprise-grade, institutional-grade DeFi yield generation strategies do require a ton of infrastructure. It's not enough we have clever ideas and a way to generating yield. If you want to do it at a scale, there is a ton of building blocks. Among those building blocks, risk is a first-class citizen. There is a ton of risk, intrinsic risk embedded into the protocols of this ecosystem, and you should think about it. I'm gonna go to questions, but before that, I would like to tell you about the next webinar. Or my colleague Lucas Otomuro is gonna talk about the current bull run in crypto assets and why it's going to give you a crypto data centric perspective about why this bull run is different. But looking at it from data, from the data perspective, we're not going to be talking about, okay, a ton of institutions and everything you read on the news, but look at a data centric perspective of what are the key characteristics of this bull run. It should be a fascinating webinar. With that, I would like to go to questions. You can use the Q&A panel. I see a few people raise their hand. If you want to contact me after the webinar, you can use my email, jr@intotheblog.com, or send me a note through our Medium page. With that, I would like to go to questions. If you have any questions, please use the Q&A panel. I saw a few people that raised their hands, but I don't see any questions. A few people are asking if the slides will be available. Yes, they will be shortly after, and so is the recording. With that, Let's see. Okay, so there is. Oh no, it's more questions about the recording. Yes, the recording will be posted shortly after the webinar in our YouTube page. So with that, questions going once, questions going twice, and well, no questions. So that's a first. So thank you very much for joining. I hope the content was valuable, and I hope to see you in a new in our next webinar. Thank you.